Assalamu alaikum, everyone. So, today our topic is money, banking, and Islamic finance 101. So, before I review what we talked about the last time, so today we're going to talk about Islamic finance during this holy month of Ramadan, especially how meaningful it is because we know during Ramadan is a month of reflection, spiritual reflection, and self-discipline and community support. Here is why this subject is so relevant during this blessed month. 1. Strengthening our connection to halal earnings. So Islamic teaches that our money should come from halal, meaning lawful sources. So Ramadan is a time when we seek purity in both body and soul. This includes purifying our wealth. Learning about Islamic finance helps us avoid what we call riba, which is interest rate. Interest rates is considered haram in Islam. So haram investment and dishonest business practices. So the question always people tend to ask, or you might ask yourself, is if we are carefully about earning halal food during Ramadan, okay, shouldn't we also ensure that our money is earned in a halal way? So emphasizing fairness and helping others, like zakat. We know during this month of Ramadan, we engage a lot in zakat. And zakat is a key part of Islamic finance, especially during this holy month. So it is a reminder that the wealth should be circulated fairly, not hoarded. What I mean by hoarded, meaning that we just keep the money to ourselves or use it to exploit others. So Islamic finance promotes fairness by ensuring profit sharing. So when you have profit, you share the profit. Risk sharing, like risk, because when you're doing business, what happens, you tend to take more risk. So you have to share the risk. And ethical business practices. So if you're doing business, you cheating your people you're doing business with, then that's unethical. And in Islam, we tend to avoid interest-based loans and speculations. We talked about that in our previous video. Speculation protects the poor and the needy from financial exploitations. So how can we build a community where no one is trapped in debt because of interest? Because we know interest rate tends to accumulate over a period of time and people become overburdened with that. And also, Ramadan is the best time to reflect on how we handle our money and business. So many people focus on spiritual growth, but forget about their financial decisions also affect their afterlife. So it's not just about spirituality. Learning about Islamic finance encourages us to change our habits and align our money matters with our faith. So are we using our money in a way that pleases Allah subhanahu wa ta'ala, or are we engaging in doubtful financial activities? Preparing for better future. Many people make a financial resolution after Ramadan, just how we do some spiritual promising ourselves to do more regular prayers, practicing all those. So it's similarly just like, our spiritual resolutions. So this is a perfect time to learn how to invest wisely, avoid haram earnings, and grow wealth in a halal way. Families can start planning to how to manage your money ethically for future generations. What are some of the steps that we can take after Ramadan to build a halal and ethical financial future? Ramadan is about community. Islamic finance builds strong communities. Islamic finance is based on justice, fairness, and mutual benefit. Just like Ramadan teaches us to care for others, ethical finance helps the poor, farmers, businesses, and entire communities grow together. This is a time to discuss how we can support each other financially while following Islamic principles. So we might ask ourselves, how can we create an interest-free support system in our villages or our communities or our cities, to help each other grow? So Ramadan is not just about prayers and fasting, it's also about bettering our entire life, including our finances. And by having halal money leads to barakah, which means blessings, while haram earnings led to stress and loss in the long run. So by learning these things, we can align our financial decisions with our faith, okay, and again, reward in both this life and the next. So, that being said, now let's take a look at our topic for today. We continue from the last time where we stopped when we talk about Islam and money. We talked about forex, we talk about daily practices. So today we go into the fundamentals, the foundations of Islamic finance, okay? Because we know that it's a system that operates under the Sharia law, which means the Islamic law, okay? Principles that emphasize ethical investing, risk sharing, and prohibitions of interest. So we know in the Western world, the key about business, the fundamental, the basic, the foundation of all businesses is interest. Okay, whether you're doing mortgages, loans, or repo, or bank-to-bank trade, or shadow banking, all this is highly dependent on interest. So in Islam, it's forbidden. Interest is forbidden. So since we are talking Islam-based, so we're going to center about our understanding of the Islamic financial system. I'm not saying it's the best Islamic financial system or it's the worst. I'm just trying for people to understand this is what the Islamic financial system is. And after the Ramadan, we're also going to talk about the other systems, like our money and banking in the Western world. Okay, so because this helps ensure we have a base, fairness, transparency, and avoid exploitative practices. So key principles of Islamic finance. So when we talk about Islamic finance, we have key principles to look for. So number one, as I said, is the prohibition of riba or interest. Interest-bearing transactions are forbidden, as making money from money without productive effort is considered unjust. So if you just turning over money into money without an actual material that supports that transaction is considered riba, which means interest. So risk sharing and profit loss sharing. Investment should be based on real economic activities where profit and loss are shared between parties. So if you are doing transactions, which is, I will give examples later on the talk, but I just want us to understand the concept, because when you understand the fundamental, the concept, then you can able to relate it to so many other practices. So we have profit and loss shares between parties. Okay, so prohibition of haram activities. So for example, investment in business dealing with alcohol or gambling or pork or all these unethical industries are forbidden. So if you are a trader or an investor or a business personnel, if you involve your financial transactions in these kind of things, is considered haram. So we also have asset-backed financing. So like transactions must be backed by tangible assets, okay, or services, ensuring economical stability. So, when we talk about financial transactions, these transactions must be backed by an actual asset. Like, for example, if you buy in a house or you buy in a goat or a sheep or a car, those are actual transactions with assets rather than just trading money for money or doing so that we ensure that there is a stability. So we talked about also what we call avoidance of excessive uncertainty, that is garara, okay, in Islam. So highly speculative and uncertainty transactions such as gambling and excessive derivative trading. We know now, like during the 2008 financial crisis, we had a lot of derivative, meaning like options, futures, and stocks. Those were all CDOs, okay. So all these things we are highly speculative, and so all those things are considered what we say garara, okay. So these are speculative uncertainties, and this is considered haram in financial Islam, in the Islamic finance world. However, there are certain conditions. Okay, so we'll talk about those conditions and later on the video. So common financial, we talked about common financial Islamic instrument the last time. We talked about what we said mudarraba. Mudarraba is profit sharing. Okay, so one party provide capital and other manages the business. So profit are shared, but losses are borne only by the investor unless mismanagement occurs. All right, so if I provide capital and you provide the service, and when we have profit, we can share the profit equally, or with some ratios. Or beforehand, you have to agree which ratio you guys have to share the profit. And if it's a loss, then the person with the capital forfeit the finance he or she put in the transaction. So number 2 is what we call joint venture or musharaka. We talked about that the last time. I'm just going over what we talked about the last time. So all partners contribute capital and share profit losses according to an agreed ratio. So the initial one, mudarraba, is one entity is providing the capital or the finance, and the other entity is providing the service or the work. And in musharraka is joint venture. So we coming together. Both of us are bringing money in the table. Okay, I'm also bringing finance. You are also bringing finance. So we get this transaction. So that way we have also profit and loss are shared equally. If you remember, for mudarraba, only the person who have the finance bear the losses. Okay, so that there is a difficulty in that. But for musharraka, which is joint venture, so if there is a loss, both of us share the loss because we both put money. But if there is a profit, it's also the same. But we just have to agree beforehand how the ratio in which we're going to share the profit and the loss, maybe based on how much finance we put into the business. So that is musharraka. So murabbaha is cost plus financing. We talked about that, where a bank buys an asset and sells it to the customer at a markup with payment structured over time. So this is what I was saying earlier during the 2007-2008 financial crisis. Okay, so these banks were giving loans to people and asking for interest that was exorbitant, meaning that it was high. And what happened, people were failing to pay back these loans, and this had a cascading effect, meaning that when one person failed, many people started failing, and then there were a lot of houses. So we had the housing crisis, and that led to Lehman Brothers to fail, Bear Stearns and other top AIG companies in the United States and all over the world. Okay, so that is so in Islamic finance, they avoided that kind of, so to avoid such kind of situations to happen in the future. So what banks will do instead, because remember in the financial crisis, the banks were just like middlemen. Okay, so they are just like a broker. If a broker is somebody is a middleman, they just bring two people together, a buyer and a seller, and then what happens is that they charge them a little bit price, so they make profit from the person who is buying the house. So but in Islam, so murabbaha, which is cost plus financing, instead of so the bank will buy the actual asset and then sell it to the buyer. Okay, so if I have a house, I want to sell my house, and somebody is looking for a house, so what the bank will do, the bank will buy the house from me first and then sell it at a markup price, okay, ahead of time. So there is no interest. We are in the Western world. What happens is, if I want to sell a house, what the bank will do, they will look for someone who want to buy the house, and they will be in the middle between you two. They might loan the person. There is a whole lot of nuances behind the scenes what happens, that we'll talk about that more on when we talk about the hierarchy of institutions, from central banks to banks, all the way to community banks to we have hierarchy of money also, so we will talk about that later. There's a lot of, so I just want us to understand the concept on the Islamic point of view. So that is murabbaha. Okay, so the bank will buy the house and then they sell it at a fixed price. So you know that, let's say the house costs 1 million US dollars, and then what the bank will do, they will just buy it for 1 million, and then maybe they have 5,000 US or 10,000 on top, so they will sell it to you at 1 million, 10,000, 1 million, 100,000. So that is fixed. There is no interest there. So you're gonna pay by installment over a period of time. But for like the West, so what they do, if they give you at the interest, even though you might refinance, but what happens is that the interest keep accumulating. So maybe by the end of your payment, when your mortgage is finished, what happens is that you pay more than the amount. You know, maybe if you at the beginning, if it cost you 1,100,000, if interest rate keep increasing, then you might pay maybe 1,300,000, 1,400,000 by the end of the day. So the Islamic point of view, to avoid that, that's what murabbaha is. So we also have what we call ijara, like leasing, okay, similar to leasing, where an asset is rented with an option to buy. Okay, so if you are living in a house, we are in at the end of the day, you pay in rent. Okay, it's not your house, so you have this lease agreement with the owner of the house, and so you can stay for 1 year, for 1 month, as depending on what the agreement says, what the contract says. So that's a normal rent. You pay rent, you live in the house. However, there are other cases where Islamic leasing, ijara, is wherein it's similar to leasing, but you pay for the house, but at the end of the day, you own the house. Okay, so you're living in the house and you paying, you having a contract, a leasing agreement. Okay, you're living in the house, you're paying, but at the end of maybe you pay for 1 year, 5 years, 10 years time. So by the time that rent accumulation, it's like you are buying the house, but you are still living there. So that is what is called ijara. And sukuk, we talked about that, which is bonds, asset-backed security, representing ownership in a tangible asset rather than debt. So what we mean by that, ownership, we know, so if you have asset-backed security, what is that? Asset-backed securities is ownership of a tangible asset, okay, rather than debt. So in the Western world, what happens is, for example, if government need money, there are many ways they can do that. Okay, they can go to the bank and ask for loans, okay, or they can ask the community to borrow them money. So what happens is, even anyone can do this. Corporations do this, like businesses. If you have your business, you need money. What happens is that you went to somebody and asked them, say, hey, can you invest in my business? Okay, and we have those investors, all right. Or you can meet a friend or a family, but it should be official. Okay, so you can write a piece of paper and give to that person as a guarantee, of kind of a contract that, hey, you owe me certain amount of money and you can pay me with interest. That's what bonds is. So bonds is borrowing money, and you are borrowing money from someone. Okay, so let's use the government, for example. So if the government need money, what they do, they write bonds. Okay, they issue bonds. So we have what we call treasury bills, treasury bonds. Okay, we have notes. So bills, so they will write a piece of paper and give it to you to say that X person, we owe X person certain amount of money. So you lending the government money. The government is borrowing from you. So when the government is borrowing from you, maybe they want to build a bridge, maybe they want to start a project, build a school or a hospital, but government don't have money. Not all all government are broke. So what happens is that they borrow money to the citizens of the country. Okay, so they will write bonds and say, hey, can you buy those bonds at a certain interest? Okay, so they will say, hey, can you borrow us money for 1 week or 2 days, or they can borrow money for 1 year or 10 years or 20 years or 30 years. Okay, so but depending on how long you are borrowing the government your money, that's how they charge you interest. So for example, if you are giving your money to the government for 10 years, they will you will charge them more interest because they are holding your money for a longer period of time. Okay, unlike if it's just for 2 days, 3 days, so the interest will be low. So maybe for So if they issue bonds, if the government issue bonds for like 2 days or 1 week, the interest they will pay on the bond will be smaller, because you are not giving them your money for a longer period of time. Wherein if you are giving the government your money, let's say for 10 years, for 20 years, okay, so you expect a higher return. So the longer you give them your money, the longer you expect the interest rate increases. Okay, so but in Islam, because interest is haram, so how they do it, instead of they pay you interest, they give you part of the profit they make. So what I mean by that is that, okay, so in the Western world, interest, so they give you have like a fixed interest rate. Okay, we are in depending on the time of the bond, okay, to maturity before the bond expires. So they will pay you that interest. Okay, so what government does is that they collect all those money. So they collect all those money, they will build a bridge, for example. Okay, so when they build that bridge, they will charge people to use the bridge. So when they charge people to use the bridge, so what happens is that then the people will pay to use the bridge, and then they get profit, and that profit now they will use it for something else. Okay, but they will not share the profit with you, because you guys have already agreed the amount, and they're gonna give you in a form of interest. Okay, but in Islam now, Islamic bonds, they work like this. So they will not. So when you lend the Islamic government money, so instead of they give you interest, they give you profit from what they did with the money. So when they collected your money, they went and built a bridge. So when people are using that bridge, what happened is that they will collect the money, and then they give you profit from that investment they did, whether they build a school or they build a bridge or a hospital or a factory or all those kind of things. So that's how Islamic bonds work. Okay, so it's asset-backed securities. So this was the key issue during the financial crisis of 2008. So in Islam, that's why the financial crisis was more hit. It hit more like the Western world, like the United States or Europe or Asia. But like in the Arab world, they were less affected by the financial crisis of 2008, because they have this kind of system, which is the sukuk. And also we have what we call takaful, which is the Islamic insurance. Okay, so a cooperative system where participants contribute to a shared pool to cover potential losses collectively. So in insurance, we know how insurance works, right? So if you have your house or your car, you are supposed to have an insurance. It's a must. So what that means is that if something wrong with your house, for example, if your house gets burnt down, so the insurance will pay for your house. But what happens at certain time, you keep paying certain amount, okay, over a period of time. So in Islam, but what happened, insurance companies, most times we know they don't pay. For example, what happened in California, where there was a lot of houses that was burnt down. So the insurance companies, some of them declare bankruptcy, because the expenditure was too much for them to handle. So in Islam, to avoid that, what happened is that a cooperative system, participants contribute to shared pool to cover potential losses, instead of just collecting premiums from people. Participants just put their finances together, and then if there is a situation, then they step in. So basically, that's what we talked about, Islamic finance versus conventional finance, in our previous video, where we talk about the key features in Islamic finance. And when we talk about riba, we know that is forbidden in Islamic finance. But in conventional finance, when I say conventional finance, I mean like the Western world system, loans, deposit, these are common. For example, deposit is when you put your money in the bank, the bank will give you some interest. And what they do is that it's not that if you put your money in the bank is going to keep your money there. So the government or the regulatory system bodies, they have a certain percentage of amount they should keep there. For example, if you put $100 in your bank account, if it's a 10%, so it is there is a rule, the Basel rules. Okay, that's a whole other topic on its own. But what happened is that they said that, okay, the bank should keep 10%. So if you put $100, so the $90 they will take it out and loan it, okay, outside. Because remember, your money that you put in the bank, that's a liability to the bank. Okay, so meaning that it's a burden to the bank because it's people's money, and so they will not just be keeping those money. They wanna improve the community. They wanna improve the cities they are in. So what they will do, and they are not doing it to do you a favor. They are doing it to make profit. So what happens is that they will take that money, they give it to somebody. That person will go and invest the money, and then they will charge that person interest. And then you also put in your money in the bank, they will give you a little interest. And then when they loan the money out, they charge that person they are giving the money to an interest. So the bank, they make that difference. It's called the term spread. Okay, so that difference between how much they pay you on your money and how much they are getting, that difference is what banks make. That's the money they make. It's called term spread. There's a lot in there. So in conventional finance or banking system, that's how banks works. We are in risk in Islamic finance, that is forbidden. So that's why they have this other alternative. And also risk sharing. Okay, so in Islamic finance, it encourages risk sharing. Okay, we are in conventional finance, it is fixed. Okay, so we have also ethical investment, which is mandatory in Islamic finance. In conventional finance, it is not required. Okay, in Islamic finance, we consider a moral hazard. Okay, like reasons for not to cheat and lie. You have to be honest and all that. But in the conventional world, conventional finance is not mandatory. Okay, to do ethical investment. Okay, so we talk about speculations and garara. We should avoid that in Islamic finance. In conventional finance, there is no problem with that. So we also have asset-backed is required. Okay, for Islamic finance, you cannot just trade money for money, without any, that's guessing, that's gambling. Okay, like options, features. We will talk about that later on, about options and features. But they are also, if you are trading a asset backed, okay, so it is okay. But if you are not trading with asset backed, like in conventional finance, it's not required. So what are some of the applications of Islamic finance? So institutions that offer Sharia compliant financial services. So for example, in the Western world now, they have certain institutions, certain banks, so they offer, because they see there are more Muslims now around the world. People are so concerned about this. We have Muslim millionaires, we have Muslim billionaires, we have Muslim trillionaires. Okay, so like for example, those in the Middle East, they want to invest in the Western world, but they're trying to mitigate these risk, okay, or these forbidden things like interest. So what banks or or financial institutions are doing now, they're offering this system. Okay, so some banks, if you ask them, they offer this system, which is institutions that offer the Sharia compliant financial services. Okay, and also they have this halal investment funds. Okay, but if you ask them, they explain to you, even though sometimes there are some nuances in that, but if you ask them, they have that. If you ask the banks, sometimes the banks make provision for that. Funds like investing in compliant sectors like real estate or healthcare or technology. Okay, and in microfinance is also a key. It providing small scale interest-free loans to promote entrepreneurship. So that's one of the biggest things in terms of development in a country. Small businesses, helping small businesses. For example, here in the United States, 60% of the population that is employed are employed by small businesses. Okay, and that is true also for some European countries, including Germany. So I was in Germany, so they have what they call it Ausbildung, like Techvuk in this or community colleges here in the US or in other part of the world. They call it Techvuk, like in Sierra Leone. So these are, these support small businesses. So that's what microfinance is. It provides small scale interest-free loans. Okay, so for Islamic finance, they provide it interest-free, but we know for the Western world, it is not interest-free. Okay, so also real estate and infrastructure. Many large projects now, especially in the Middle East, okay, and Asia, they are funded through Islamic finance. Okay, so there is no interest charge, but however, you share the profit with the people. Okay, so now let's explain this with some examples so that we can able to understand this better about Islamic finance, money, and the halal way. All right. So there are pros and cons to everything. Okay. So in conventional finances, we have a lot of financial crisis. We know in the Great Depression of 1913 or so, that was the biggest financial crisis. After that, also we had one in the 80s, we had one in the 90s, we had one in 2001. We had one after 2007, one of the biggest one, right, in 2007, 2008, since the Great Depression. And after that, we had one in 2019, 2020 during the COVID virus. Okay, in 2019, COVID-19, we had a financial crisis. So all these are challenges because we'll talk about that in our money and banking conversation we are in. We have hierarchy of money, so we have hierarchy of institutions, and at any point in time in the economy, what happened? We have an expansion phase and a contraction, meaning that at some point there will be a lot of transactions happening, money is flowing in the economy, there are a lot of liquidity, meaning money is going back and forth, people are making money. And then what happens is that people tend to be reckless, they take more risk, and then so there is a hierarchy of money. We have what we call credit, we have securities, we have deposit, we have money, we have gold. Gold is the ultimate money. We talk about that. We'll talk about the history of money, how money come about in some other videos, maybe after the Ramadan, because I just do this one during Ramadan to make people understand the Islamic point of view, okay, of finance. But anyway, so back to our topic. So Islamic finance is a system of handling money the right way, okay, so without cheating, without unfair profit, and without harming others. Okay, it follows the Sharia law, meaning no interest, okay, no riba, and no involvement in haram businesses like alcohol, gambling, or pork. So let's talk about how it works with some simple examples that we can able to understand. Okay, so let's say our neighbor, all right, you have your neighbor there, all right, let's call him Ali. Okay, so Ali needs, let's say, $100 to start a small farm. Okay, he wants to start his farm here, he needs $100. So in a normal bank, in a conventional bank in the Western world, if Ali borrows $100, he must pay back $120. So the extra $20 is the interest, is the riba. Okay, so Ali had the farm, so he's borrowing money from the bank. Okay, $100. I say this. We're just making examples. Okay, the farm will cost him $100 to do. So the bank will say, okay, we'll lend you this $100, but then you have to pay us back $120. So now that $20 on top is the interest, is the riba, which in Islam is haram. So people will always ask then, how Islamic finance, in Islamic world, how do they make money? So here is how they do. So in Islamic finance, instead of a loan, you and Ali partner up. You give him $100, and after harvest, he give you a fair share of the profit. If there is a loss, you both share it. So here let me explain. So in Islamic finance, so if Ali goes to the bank, okay, so instead of the bank loan Ali $100 and ask him for $20 interest, the bank will say, okay, now we are partners, meaning that I will give you the $100 as I'm the one providing the fund, and you going to do the work, meaning you're going to do the farming, okay, and then after you do the farming, when there is profit, what happened is that we share the profit. You give me some of your profit, okay? So maybe you give me certain amount of percentage of the profit. So it's different. It's a very subtle difference, but think it through, okay? If it's a normal bank, the Western world type of banking system, you go into the bank, you asking them to give you loan. They loaning you $100 and they charging you interest, maybe 20% interest in this case, so that's $20. So it's 20% interest, so you're going to pay $120 after your farm. But in the Islamic finance world, you sharing the profit. You go into the bank, the same thing. You're asking them to be your partner, not to loan you money, but to be your partner. So they're giving you, saying, okay, we are going to give you $100 as a partner because you don't have the money, but you have the expertise. We have the money, we don't have the expertise. So what happens is that we're gonna give you the $100, but when you go, you invest it on your farm and you make profit, you're gonna give us some part of that profit. Okay, so but again, we know in business there is also the other side of the transaction, right? Which anything happens, there might be a loss, right? So if there is a loss again, so you guys will share the loss. You know, in the Western world, we know sometimes you have to declare bankruptcy, otherwise you have to find a way to pay the loan and all that. There are a lot of nuances in that. But in Islam, then you share the loss. Of course, you're gonna provide evidence, proof that yes, you lose some of that. So in Islamic banking also, we have what we call honest buying and selling. Let's say Fatima, okay, wants to buy a cow for her dairy business, okay, but she doesn't have the money. So a normal bank will lend her money and charge interest. Okay, an Islamic bank will buy the cow for $500, let's say for example, and sell it to Fatima for $550 in installment. She knows exactly what she is paying, no hidden fees, no unfair charges. Okay, so let me explain what I mean by that. Now Fatima want to buy a cow. She's in the dairy business, meaning that she make milk. So if she goes to the bank, normal bank like Western World Bank, all right, and what happens is that let me go back. So what happened is that Fatima, they will give her the $500, but then they will charge her interest. Okay, they will say, oh, we're going to pay us 10% or 20% interest, then you pay that amount. But then sometimes there's hidden fees, there are extra charges, interest rate might goes up, interest rate might come down, there will be refinancing and all that back and forth. But in Islamic banking, what Islamic banking does is that if Fatima goes to the bank, just like Ali previously when we talk about Ali, so what happens is that the bank will go and buy the $500. Okay, they will take the $500, they go and buy the cow, and then they will say, okay, now Fatima, you're gonna buy this cow we're gonna give you this cow, but you're gonna give us $550. So Fatima know exactly that she's paying $550. So that's not interest. Okay, so that's the difference. That is the difference between our examples. Okay, so her money is charged, she know exactly what she's paying, no hidden fees. Okay, so that's the Islamic banking point of view on this example. Okay, so in terms of the insurance, again, we are a group of farmers make money. So if one farmer crops get destroyed, he get help from that pool. So now the takaful we spoke about earlier, okay, we are in Islamic insurance. In the Western world, you pay insurance over if you have a farm, a house, you pay insurance for everything. Life insurance, health insurance. Insurance is the most crazy thing in the Western world, right? So you pay, then there is premium, they collect the premium. If something wrong with your house, they will step in and help out. All right, but in Islamic finance, how they do it is this. So like, let's say we are farmers, okay, we're a group of farmers, they will come together, they will put money together. Okay, so if one farmer crops get destroyed, he get help from that pool. So similarly with insurance, right? Because insurance, you are paying also some premium at the end of the day. If something happens with your house or your farm, they will step in. If something doesn't happen, you lose the money. So but in this case, the difference, there are subtle differences. Okay, so in this case, so the group of farmers, they put the money together into a pool. Okay, so if one of the farmers, the farmland get destroyed, so they will use that money to help that farmer. So no one profit unfairly, just people helping each other. Okay, so that's the subtle difference. In the insurance world, we know the insurance companies benefit. Okay, they can declare bankruptcy and all that. Okay, then you lose your farm, you lose all the money that you were giving them as part for your insurance. Okay, so but in this case, nobody is profiting. Okay, except the person that loses. Okay, so and lost, we don't know whose farm gonna be destroyed. Okay, so that's the difference. So now let's talk about stocks. So stocks is owning a piece of a business. Okay, so when we have stocks, we talk about bonds earlier, we have options, we have features, we have all these types. Okay, so now let's talk about stocks, owning a piece of a business. So a stock is a small piece of a company. When you buy a stock, you become a part owner of that business. If the company does well, the stock price goes up and you make money. If it does poorly, the stock price falls and you may lose money. All right, so what I mean, let me explain. So let's say I have a business, okay? So I've been running this business, it's small, but I want to make it big. All right, so here in the United States, that's where Wall Street comes into play. Okay, so you can take this company public. You can IPO this company. They call it initial public offering, wherein you can take it to Wall Street, to these investment banks. They will take your company, they will break it down into pieces, into chunks. Okay, like companies like Apple, Facebook, now it's called Meta, right? Amazon, you name it, any company, Tesla, Microsoft, all these big names, or even small companies that you never heard of. Okay, they are traded in the stock market. That's where the stock market comes from the word stock. It's like so they take that company, the investment banks, they will break it down to pieces, then they will sell it to investors out there. Okay, I will talk about that in some subsequent videos. That's a whole world on its own, trading stocks. That's what I do for a living and all that. But here I just want us to understand it in relation to Islam, okay? Because we're doing this program in relation to Islam. So a stock is so if I have the company, they will look, the investment bank will look and say, okay, your company worth X, Y, and Z amount. Okay, so what happens is that they will take the company, break it down into chunks, and then they will sell it to people. So now you are not the only one that own the company. So now people will buy those chunks, those stocks of that company. And what happens is that, and so if now you will collect that money, you invest it in the company, and then you improve the company, then the company will grow. Then those values, those stocks, okay, those stocks, their value will accumulate over a period of time. Okay, and then you make money. So you derive more profit from that. Okay. But the opposite is also true. So if the company does poorly, then you will lose money. Okay, prices will fall. So imagine, for example, in our community or in our village or in our city, we have a rice mill, okay, owned by one family. So let's say, this family owned this rice mill, okay. So now they decide to share these stocks, okay. So anyone can invest. So let's say in our community, okay, so we have a farm, okay, we want to do farming, okay. So what we did is that, okay, so we say, okay, this farm that we're doing, we're breaking it down into chunks, okay. Let's say we're breaking it into 100 stocks. So each stock will be sold at a certain price, let's say $10 or $100, okay. So 10 times 100, that's $1,000. So we generated $1,000. So if 10 people buy it or one person can buy it, it doesn't matter. So what happens is that, so everybody will come and buy, will bid for that price investment, okay? So then they will give you the money, then you will take that money, you go and invest it, you go do the rice mill. From then, the profit, now you come and share it again, so the prices will accumulate. Okay, so to the investors, they call that investors. So this is a whole world on its own. It's the stock market is a trillions of dollars. Okay, the world is centered around the stock market. Okay, so if you buy like 10% shares of a company, you own 10% of that company. Let's say, for example, you heard about Amazon or Meta, okay, or Tesla or Apple. So what happened? These companies are traded in the stock market. So if you have, if you like, they have a price every day, you see these prices will move up and down, okay, depending on news, depending on depending on what's going on around the world. So that all that influences these prices. So what people do, investors like me and you have retail people who have no money, people who have less money, and people who have billions or trillions, they all invest. Okay, so you just go, you can buy one share of that company, and then what happens is you invest, you are part owner of that company. So instead of going to buy the Apple phone, for example, okay, so when you buy the phone, you have an Apple phone, right? But you have nothing to do with the company. You don't own the company. You are not the owner of Apple, okay? You just bought the Apple phone. Wherein if you buy the stock, and now you are part owner of Apple. Okay, so you owning a piece of Apple, the company of itself. Okay, so now you are part ownership. You have part ownership of that company. So if you buy like 10% of shares, you own 10% of the rice mill, for our own example. Okay, so if the rice mill makes good profit, now you get your shares of the money. Okay, you make some profit. So if the mill struggle, your share values goes down. Okay, but here is the thing. Let's say if it costs $10 to buy it, if the stock goes to zero, you will only lose the $10. Okay, but it can go to 100, it can go to 1,000, it can go millions. Okay, so you make that amount, but if you lose, you can only lose the certain amount you put inside the stock. So that's what that is. So the halal stocks now is you can invest in companies that follow Islamic principles. So here is the Islamic make. So like I said, in the stock market, there are a lot of different companies. Okay, they have, like I told you, the big 7 companies. They call them like Nvidia, Apple, Microsoft, Tesla, Google, Meta, which is Facebook. Okay, and Broadcom. All these top companies. They also have small companies, like small businesses. Okay, that do like gambling, do agriculture, do healthcare, do food, do drugs, do, like, when I say drugs, I don't mean the doing drugs that way, like drugs in terms of medicine. Okay, like we have medicine, that's the type of drugs I'm talking about. Okay, so but we also have companies that do gambling and alcohol. So and we know that in Islam those are haram. Okay, like, so what you do, you don't invest in things that is haram. Okay, if you are a Muslim and you think of you are concerned about where your money is going, so instead of you invest in companies that have alcohol or gambling or interest-based businesses, you just invest in companies that do agriculture, like healthcare or halal food or mobile phones, because those are not haram. So, and now we turn our attention. So this is a whole field on its own. It's a whole world on its own. Maybe some other time we'll talk about that more in great details. You know, and you have to be a financial advisor even to talk about that. And I'm not a financial advisor, so don't take this as an advice to go and buy these companies. I'm not advising. I'm just explaining. Okay. So options 3, betting on the future price. Okay. So an option is a contract that gives you the right but not the obligation to buy or sell something at a price in the future. Okay, so options. So now let's talk about what options is. This gives you, so now let's say again you want to buy this. Okay, you believe the price of a goat. Let's say you want to buy a goat. Okay, we rise from $100 to $150 in 3 months. So what you do, you make a deal with the seller. So you say, I'll pay you $10 today, and if the price goes up, I can still buy the goat at $100. But if the price does rise to $150, you use your option to buy $100 and sell for a profit. If the price stays $100 or drops, you can walk away losing only $10. Let me explain what that means. So options is that you see this goat. Okay, you go to the market, and there is this goat is selling for $100. But now, instead of you buying that goat at that price, $100, right now, you say, because you think the price of goat will go up to $150 in the future, but you are not sure. Okay, it might go to $90 maybe by tomorrow or 2 days later or 10 days later. Okay, but you are not sure. But you want to buy this good, but you don't want to buy it at this price right now. So what you will do, you will talk to the person who is selling the goat. Say, listen, I know goat is $100 right now, and I want to buy it, but I don't want to buy it right now. But I would really want to buy it for $100. But I want to buy it if it goes up. So what happened is that I'll make a deal with you. I'll give you $10 today instead of $100. I'll give you $10 today. If tomorrow or next tomorrow when I come, if the price of the goat is $150, you will still sell it to me for $100. If it's $90, I will just walk away. You will just take the $10. You don't have to sell me the goat. Well, what's the good thing there for the seller? The seller also is not sure whether goat price will be $150 tomorrow or not. And maybe he don't have anybody that is buying the goats today. So what he will say, okay, I'll keep the goat for you until next tomorrow. Okay, if goat price goes to $150, I'll still sell you $100, and now I have $10 because you give me $10 today. But if the goat price goes down $90, you don't want to buy it at 100, right? Because it's already 90. But if it goes to 150, you want to buy it at 100 and then sell it 150. You make the difference, right? But if it goes down to 90, while you already have a contract for 100, I mean, so you don't want to buy it at 100 because you will lose 10. So what happened is that you agree, say, okay, if it goes down to 90, the $10 I gave you initially, you keep it. I'll not buy the goat. Okay, so I will just go buy it 90 plus that $10 I give that person, so it's 100. So either way, you better off. And that is also true for the person who is selling the goat, because if the goat goes down to 90, so he will sell it at 90 now, but he also have a $10 that the other person gave it to him. Okay, so he still sell it for $100. If it goes 150, he was already planning to sell it at 100. So now he will just sell it at 100 plus the $10 that person gave him, so he make $110. So either way, they are both is win-win for both parties. So here is the Islamic point of view. Options is also a whole topic on its own. We'll talk more details on that on subsequent videos. Options are risky, okay, and often involve speculation. So what happened now in the Western world is that, so now what people are doing now, instead of buying the actual gold, they are just speculating. Now, so if they are just speculating, that's haram. But if you are buying the actual goat or the sheep or the cow or the company, it is not haram. So that's the difference with finance in Islamic finance, okay? And futures. So now we have also what we call futures. So buying and selling in advance. Okay, earlier we talked about options. So futures are agreement to buy or sell something at a fixed price on a set date in the future. Unlike options, future contract must be honored. Okay, so remember, for the option we said, okay, you don't have to buy it, right? But you will lose your money because you give the person the money already. But futures now is that you are agreeing to buy it in future date, but now it is mandatory. So whether it goes down or it goes up, you have to buy it. That's the difference with futures. Okay, so let's say a wheat farmer is worried that wheat prices might drop at harvest time. Okay, a flour mill is worried that wheat prices might go up. So what they do, they will agree today that the flour mill buy 100 sacks of wheat from the farmer for $50 peak after 3 months. Okay, so if the price rises to $60, the mill still pay $50 and it saves money. Okay, but if it drops, if the price falls to $40, the farmer is happy because he still gets $50 per sack. But the difference with options and futures is that this is for a future date. That's why it's called future, and it's mandatory. You have to buy it. Okay, it's not like you don't have option. So the previous one, we'll call it option because it's optional. If you want, you can do it. If you want, you don't. Okay, it's optional. And but you lose the premium you paid. Okay, but for futures it is mandatory and it is in the future, so you are not paying today. Remember, for the option you are paying today with the option to buy later. or not to buy if you don't choose to. Okay, for futures, you are agreeing today to pay in the future. That's why it is called futures. Okay, so that's the difference. So now let's just do a quick recap. So Islamic finance is all about honest and ethical, no interest rate, fair business, no gambling. Okay, we talk about stocks, owning a part of a company, like making money when it grows. We talk about options, betting on future prices, like risky and often considered haram. With futures, agreed price for future date, like useful for farmers and businesses. Okay, so here, for me to conclude, here are things that I want you to think about as you're thinking through these things. So why do you think Islam forbid interest? So these are great questions to ask. Okay, so why you think interest is haram in Islam? Okay, so if two people start a business, one provide the money and the other does the work, how do you think they should share that amount? Okay, what's the ratio? So these are some of the challenges now Islamic finance faces. Okay, so how will you share it? So will you rather borrow money with interest or have a partner who share profit and risk? Which one you think is better? Okay, and so in terms of stocks, okay, so let's say if you could buy a share, when would you buy it or will you not? Okay, so if a business is doing well today, does that mean it will always be doing well? That is not necessarily true, right? It might be doing well today. We know businesses fail, businesses grow, and then they fall. Okay, so all those things. So what do you think makes a company a good investment? So what are the things you look for in a company? What determines this company as a good company or as a bad company? So is it fair to invest in a company that makes a lot of money but sell haram product like alcohol or gambling, or you want to invest your money in halal things? Okay, so these are questions that you ask yourself, or you can answer. You can comment it on the section, your answers, or if you have more questions, you can put it on the section. I will go through them and then I will try to answer them maybe in the comment section or in subsequent videos. And also we talk about options. So one question is what will happen if the price goes up, and what if it goes down? Okay, what if the price of gold is fixed? All right, earlier we said if it's $100 it goes up to 150. What is say the same over that period of time? Okay, so do you think it's fair to make money from this kind of predicting without using the actual make or not? So these are kind of the challenges questions with options. Okay, would you rather trade in something real like livestock, crops, or in paper contract, just like having the contract? Or okay, so these are like the questions, general questions. Like for futures also the same thing. If a buyer agrees to buy your harvest at a fixed price before it's even grown, is that good for you? Is that Islamically good or bad? So these are some of the questions that we tend to ask ourselves. How do future contracts help businesses? Okay, so how this helps make your business grow or fall, or sometimes people just collect people's money and eat it and don't do nothing. So these are some of the challenges. Okay, so I want you to reflect on these kind of questions. Okay, how can we make sure our community follow some ethical financial practices? Okay, which one is better, the Islamic finance or the conventional finance? What are the pros of Islamic finance? What are the cons? What I mean by that is what are the advantages and disadvantages for Islamic finance and also for conventional finance? Okay, do you think modern banking system help or hurt small communities? Okay, or so why or why not? So these are kind of questions we tend to think about. Okay, so what can we do to support our communities in terms of financially? Okay, these kind of things, like that's why I'm doing this kind of thing, to help in the best way I can, because I know that finance is one of the key things in this environment, in this our society. By ensuring that people understand this concept, it helps you greatly, and in terms of your daily life and understanding the differences, the nuances of these things. Okay, so I thank everybody for watching. I'll end up here. Assalamu alaikum wa rahmatullahi wa barakatuh.